I want you to picture three people, three bankers. They all worked for the same major bank in India and they all climbed the ladder to the exact same position, senior manager, scale 3. Pranams, I'm Priyanka Chakraborty and my co host is Nisha Bhattacharya.
So pretty senior role?
Oh, yeah, a very serious position. And they all put in the same time, over 33 years of service.
So on paper, their careers look, well, almost identical, same rank, same tenure.
Exactly. The only real difference between them is the year they decided to, you know, pack it all in and retire.
Right.
So you've got banker A1 who retires way back in 1987, then banker B2 who leaves in 2002, and finally banker C3 who hangs up his boots much more recently in 2010.
All right, I think I see where this is going. I mean, standard economic logic would say that the person who retired most recently, that's banker C3 in 2010, he should be the most comfortable financially.
Right? That's the immediate assumption. Inflation happens, salaries go up. A manager's salary in 2010 is obviously way higher than it was in 1987.
So his pension, which is based on 50% of final salary, should be the highest.
It's the basic rule of how these things are supposed to work. You work later, you earn more, you retire richer. Simple.
Yes, that's the usual trajectory.
Well, today we are going to take that rule and pretty much turn it completely upside down. Because if we look at their actual bank accounts today, right now, the person who retired in 1987 earns the highest pension of the three.
That's totally flipped the pension pyramid upside down.
And it's not even close.
So it's a complete inversion of what you'd expect. It's a baffling anomaly whose root cause lies in India's inconsistent application of pension regulations.
And that's exactly what we're unpacking today, the disparities in pensions for retired PSB bank officers based on their specific date of retirement. These are the bankers who retired from 1st November 1987 to 17 March 2003, the Supreme Court's Group 2.
And just to be clear for everyone listening, we're not just guessing here. These numbers come from a very specific set of actuarial data and legal classifications.
Right. This all comes from the fallout of a Supreme Court of India instruction from February 5th of 2026.
So it's legally grounded math. We're looking at recorded facts.
And to keep it fair, we are sticking to that benchmark you mentioned at the start. Every number is for that scale 3 senior manager, retired at 60 with 33 plus years of service.
Yeah, that way we're isolating pension regulations and the bipartites as the only real variable.
Okay, so let's get into it. To understand this paradox, we first have to understand the landscape. The data and the Supreme Court splits these retirees into three distinct groups, groups 1, 2, and 3.
It's almost like geological eras, and the dividing line between them is the retirement cutoff dates and dearness relief ranges.
Dearness relief is the cost of living adjustment, right?
Exactly. DR is the extra cash the bank adds to your pension to fight that inflation. But, and this is the key, the formula for how that adjustment is calculated has changed over time.
And that's what creates our three groups.
That and updation. So, first up, you have Group 1.
These are the veterans who received pension updation in May 2020.
Yes, and they retires between January 1st, 1986 and October 31st, 1987.
The classic super seniors.
Then you have Group 2, which is our main focus. This is a huge group of people who retired between November 1st, 1987 and March 17th, 2003.
Wait, that's a massive window, more than 15 years.
It's a whole generation of bankers.
The next generation after the super seniors.
And as we'll see, they're kind of the middle child of this whole story.
Stuck in the chasm between the old rules and the new ones.
Precisely. And then finally, you have Group 3. These are the modern retirees, anyone who retired on or after March 18th, 2003.
And what makes their regime modern?
The key thing is something called 100% neutralization.
Okay, another piece of jargon. Please explain neutralization to anyone not familiar with it.
Inflation protection, it just means that if the cost of living index goes up by, say, 100 points, the bank covers that increase 100%.
It's a perfect shield.
Yes, because the cost of inflation is fully neutralized.
So that sounds like the best deal, right? I mean, you'd want the 100% coverage.
Logically, yes, it is structurally the fairest formula. But, and this is a huge but, having the best formula doesn't mean much if your starting number is low. And this is where the paradox really kicks in.
All right, let's get to the numbers. Show me the money. We promised a paradox, so let's see it. We're looking at the monthly take home pension for our benchmark manager in each group as of November 2024.
Okay, so let's start with the modern guy, banker C3. He retired in 2010.
So, pretty recently, high final salary, and he's got that 100% neutralization shield. What's he taking home?
As of late 24, his take home is about 80,700 rupees per month.
80,700. Okay, that's our baseline. Now, let's go back in time. The middle bank retiree, Group 2, our manager who retired in 2002.
So he retired 8 years earlier. His final salary would have been a lot lower than the 2010 guys.
Right? But today his pension check is
90 or 50 rupees per month.
Wait, hold on. The person who retired in 2002 is making over 10,000 rupees more per month than the person who retired 8 years later?
Yes, the 2002 retiree is significantly better off than the 2010 retiree.
My brain already hurts. But you said the 1987 guy, the one from ancient history, is the wealthiest.
Okay, be patient. Let's look at Group 1. The manager who retired all the way back in 1987, his current monthly pension is a staggering 1,035,600 rupee.
1,35,000.
1,35,000 compared to 80,000 for the modern guy.
That is just, it's a massive difference, over 50,000 rupees a month. The 1987 retiree is earning nearly double what the 2010 retiree is.
It is absolutely life-changing money. The 1987 retiree is earning nearly double what the 2010 retiree is.
How is that possible? What happened? Why is the guy who retired almost 40 years ago so much better off?
It's a perfect storm of two things, something called a one-off updation and what the source calls the golden slabs.
Updation, so like a revision, a reset.
Exactly. Normally, when you retire, your base pension is frozen. But in May of 2010, something unique happened just for Group 1. They got a one-off updation. Their base pension was revised upwards substantially.
So they got a retroactive raise 23 years after they retired.
In essence, yes. But here's the other part. They also benefit from the pre-November 1987 DR slabs, that inflation shield we talked about.
The dearness relief.
Right. The formula they use, the old one, is incredibly generous. The source material says these old slabs are currently the most beneficial slabs in the industry. They pay out way more for every point of inflation.
So let me get this straight. In 2010, they got a massive lump to their base pay, and they're on a legacy formula that pays out considerably more than modern DR slabs.
That's a perfect way to put it. It's a compounding effect.
Playing devil's advocate, I can see why the Supreme Court include Group 1 cohort in the February 5th chart request.
The source calls it the irony, saying it's exactly the reverse of what was widely believed. These 1986-87 retirees just became the unintended winners.
Unintended winners, I'll say. But I want to zoom in on that middle group, Group 2. The 2002 retiree is still beating the modern guy even without that updation. Why?
Right. This is where it comes down to just the luck of the draw. The data profiles a specific person who retired on December 31st, 2002.
Okay. New Year's Eve packs up his desk.
His basic pension was fixed at 18,080 rupees. Top of the scale back then?
Which sounds like nothing now.
Nothing. But fast forward to today, and that's ballooned to 91,450 rupees. He's maintained about 90 to 95% of his real purchasing power.
So what was his secret?
The secret was a specific piece of paper called the 2003 Gazette.
The 2003 Gazette. Sounds like a spy novel. What did it do?
It was a lifesaver for him. This regulation retrospectively gave that 100% neutralization, that perfect inflation shield, to anyone who retired between April 1st, 1998 and October 31st, 2002.
Retrospectively. So they went back in time and upgraded the math for these people?
Yes. They basically said, hey, we know you retired a few years ago under the old, weaker formula, so we're going to upgrade you to the new one.
And what if they hadn't done that?
That's a great question and it deserves an answer. Well, without that specific Gazette notification, this 2002 retiree would only be getting about 72,000 rupees today.
So instead of 91,000, he'd be at 72,000. That's almost a 20,000 rupee difference every single month.
Just because of one little notification. That document is the only reason the late Group 2 retirees are out-earning the modern Group 3 people.
This brings up a really tough question then. Group 2 runs from 1987 all the way to 2003. But you're saying the Gazette only helped people who retired after April 1998.
You've spotted the gap.
What about everyone else in Group 2, the people who retired before 1998, say in 1995 or 1990?
And this is where the story gets, well, tragic. This is what the data calls the lost generation.
The lost generation. That sounds about right.
It's the source's way of describing a subgroup that suffered what they call a grave injustice. We're talking about anyone who retired from November 1st, 1987 up to March 31st, 1998.
So the first half of Group 2?
Yes. Just think about their position. They are squeezed from both sides. First, they missed the big Group 1 updation in 2010 because they retired after October 87.
Okay, so no base salary reset for them. They're stuck with their old low base pension.
Correct. But then they also missed the 2003 Gazette benefit because they retired before April 1998.
So they didn't get the 100% inflation shield either.
Not at all. They got stuck with what's called tapered relief. Their inflation shield is basically made of cardboard. They get neither the windfall of the 1987 group nor the retrospective fix of the 2002 group.
Oh, that is just brutal. So, in this whole hierarchy of retirees, they are basically at the very bottom. In this light, it makes sense why the Supreme Court included this group in its list of chart requests.
Their purchasing power has eroded the most. By far, it's a huge inequity. And the data summarizes this whole pecking order in what it calls the final actuarial conclusion.
I want to just quickly summarize that hierarchy so you can really visualize this ladder at the top.
The undisputed king is the pre November 1987 retiree, Group 1. They are the best off by a country mile.
The runner up.
That's late Group 2, the 98 to 2002 cohort. They take the silver medal because they were saved by that 2003 Gazette.
And the losers?
The lost generation. Early Group 2, from 87 to 98. No updation, no Gazette, weak relief.
And then the surprising part is that the modern retirees, Group 3, are actually earning less than that 2002 group.
Exactly. They have the best formula on paper, but because of these specific one off fixes for other groups, they end up further down the ladder. It just shows how powerful those DR formula tweaks are.
It's not about how hard you worked or how high you climbed. It's about the specific math attached to the specific day you retired.
That's it exactly. It completely challenges the whole idea that financial progression follows career progression in retirement.
You assume if you retire later, you'll be better off. But this data says not necessarily.
It says that a couple of regulatory quirks can completely override economic fundamentals. One solitary updation in 2010 turned the whole pyramid upside down.
It's a powerful lesson. I mean, these are things that look like boring footnotes in some government document, but they have real life altering financial impacts.
It's the difference between a comfortable retirement and a struggling one, all based on whether your retirement date happened to fall inside the IBA and DFS regulatory Goldilocks zone.
Which is pretty scary, isn't it? Because you can't really control the regulatory environment you retire into. You can't predict that in 10 years, they're going to hand a massive raise to people who retired 20 years ago, but not to you.
That's the harsh reality here. You are betting on policy stability, and policy, as we see, isn't always stable.
So, I'd like to leave you, our listener, with a final thought. We've seen how a single regulatory update, like that 2010 updation or the 2003 Gazette, can just arbitrarily invert the financial hierarchy of an entire industry's retirees.
It literally turned the pyramid upside down. The oldest are at the top.
If small administrative changes can reshape outcomes this dramatically, what does that say about the stability of long term financial plans? When rules shift to make the oldest the richest and leave a lost generation in the middle, can any pension truly be called predictable?
That is the trillion rupee question.
Thanks for diving into this with us. I know it's a dense topic, but the implications are just fascinating.
My pleasure. Always good to connect the dots.
Keep crunching those numbers, watch out for those Gazette notifications, and stay curious. We'll see you on the next deep dive.
Thanks for watching. Please subscribe and share. The Supreme Court Group 3 chart will be podcast tomorrow. Don't miss it.